Thank you. Can you all hear me okay? Yes, you can? Do we have any entrepreneurs or business owners in the room? Hand up. Great. Okay, so hopefully this will be relevant and interesting to some of you. So to start with, I want to talk a little briefly about why I've got a perspective on this and where I've come from. So my early career started, as you can see, in some big traditional companies. And then in the late 90s, I went into startup land. And I worked for a startup in HomePro, which grew very fast and burned out and failed very quickly. And then I went to Ask Jeeves, which grew more slowly and then burned out and failed more slowly. So I've got two perspectives on failed .com entrepreneurial businesses. But then from there, I went to Capital One, as my boys there in a picture card, which I helped to launch. And then from there to Google. And you can see the Google Doodle for the anniversary of the tube there. And so having spent time in the startup world, and then having spent time in financial services, and then tech in Google, the next step for me was to go into fintech, helping startup businesses. And so I joined an established venture builder called Blenheim Chalcot, which I'll talk more about later, to run and grow their fintech activity as a venture builder. So some of you might be thinking, well, what the hell is a venture builder? So there's a couple of articles been written about this, but essentially it's an organization that builds companies using their own ideas and resources. What we do as a venture builder is to work with entrepreneurs and CEOs, providing them with wraparound support and funding to help improve their odds of successfully growing a business. And I want to explore a little bit about how this model differs from the typical venture-funded entrepreneurial startup route, what the pros and cons are, and why I chose that journey. First, it's worth thinking about the traditional venture route. So in the typical startup land, you have your archetypal entrepreneur, male or female. In this case, we've got a beardy guy. And with that, they bring an idea, and that idea is the basis for their business. And then they have to go through various rounds of fundraising. And it may be friends and family, and then a seed, and then angels, and then a round, to hopefully build a successful and growing business. But as we know from all the stats, the odds are not really in their favor. And actually, while you may get one business every now and again, you'll get plenty of dogs along the way which actually don't make it. So the difference between this and the venture building model is that with venture building, you start with some experienced entrepreneurs who've been there and done that and have learned how to grow businesses. And around them, they've got facilities, they've got office space, they've got support in terms of legal and finance and regulatory and payroll and so on. And they use that as the foundation for growing businesses. And they'll take possibly their ideas or possibly ideas that have come from entrepreneurs, and they'll work on those to form a better idea which takes the power of both to come up with a business that they think they can build together. And then the venture builder will ensure that the funding is in place for the duration of that entrepreneurial journey. And it may be all their own money, or it may be money that the venture builder helps to bring in from strategic co-investment partners, or by raising money from their friends and family. But they're taking the burden of worrying about money raising away from the business leader. And so in this case, the CEO can focus on running and launching and building his or her own business. And so hopefully, at the end of this, you get a successful and growing business and a much lower chance of having a dog at the end of it. So to summarize the differences for the entrepreneur, in the venture building route, they're not distracted by fundraising, which is a huge burden for small business owners. They get increased speed to market because they can accelerate a lot of that early phase because they've got the support of those experienced entrepreneurs. They've got office space, functional support that they can rely on without having to spend their time worrying about that. Crucially, they have got a network of unlockers and enablers in the venture builders that are supporting them. So if you get the right venture builder, they will know people in your target market companies. They'll know people in press and PR. They'll know people in regulatory and government if that's what you need. And that can really accelerate your progress. If the venture builder has other companies in their group that can be helpful to you in launching your company, then the fact that they will have a common ownership can really help accelerate your progress. So we have one company in our group that's trying to do a payroll benefit, and being able to push that into other companies in the group as a pilot can help prove our case before we go out to the outside world. And then crucially, if you're in a venture builder organization, you get paid a salary. So it really opens up the entrepreneurial marketplace to people who might be in a different stage of life. So to be a typical tech startup entrepreneur straight out of MBA school or university, the idea of spending 2 years living off baked beans and toast while you try and claw your way to a business may be very attractive because there's a big prize at the end of it. But if you've already got a mortgage and some kids, then you may not be able to make that choice. And so going into something where the risks are a bit lower and the basic bills are met by somebody else can be really attractive. And it avoids the loneliness of that as well. But it comes at a cost. If you're a startup entrepreneur going the traditional route, then you control your company, you control your decisions, you control your destiny, and you own the vast majority of your company. So isn't that too big a price to give away in order to get the things that are on the top half of this page? So let me go into that. Well, first of all, one of the immediate paybacks you get is the time to build your company and focus on its success. So these aren't statistically analyzed numbers, but just talking to a bunch of entrepreneurs and talking not so much about the hours they spend, but talking about the share of headspace that it occupies. They say they often spend a third of their time worrying about money, a third of their time worrying about the basic infrastructure of the business, leaving only a third of their time to worry about their proposition, their customers, their market, and growing the business. And if you can change that equation, you can really accelerate their their speed of growth and their chances of success. So that's one thing that the venture builder model offers. But in the end, most people are entrepreneurs because they want to make money. They want to make a large sum of money sometime down the road, and they want to have a reasonable chance of that success happening. So what I've done here is a very simple equation to say, what are the returns that you should expect to get from entrepreneurial activity? Well, essentially, over a certain period, you're hoping to exit your business, sell your business, where you've got a certain share of it, it's worth a certain amount, and there is a certain likelihood of that happening. And while most entrepreneurs, you need to be wildly optimistic in order to do entrepreneurial activity in the first place. But if you're realistic about it, you will put a percentage likelihood on that equation. So let's look at each of those little icons in turn. First of all, share. For the typical VC model, while you might start out owning your business, as soon as you bring in some friends and family money, you bring in some money from seed, from angels, from VCs, A-round, each time you're diluted. And the data shows that the average exiting startup business has about 20% of the share ownership in the hands of the founding entrepreneurs. So while it may be like, well, I want to own my business, if you're thinking about a long-term, externally funded business, you're going to end up with roughly 20%. So think about that rather than owning the whole thing. In the venture building model, it varies depending on the quality of the idea and the startup and how much funding is needed. But typically, the founding entrepreneur or team get about 10% of the business. But that is maintained over the life of the pre-agreed rounds of funding. So that's a different model. Still, it's 20 versus 10, but it's not as dramatic a difference as you might think going in at the beginning. Next, size of the prize. Now, clearly, there are prizes like Google, which are hundreds of billions, and there are the more likely prizes, which is no prize at all. But if we look at the average of a reasonably successful venture-funded exit, you're typically talking about 5 million in, about 25 million out, and that's what we've seen in a number of our portfolio companies. You could argue that in the venture building case, the likelihood of a bigger upside is higher because you've got experienced people helping line you up with the right sellers, helping you position and package the sale, etc. But for conservative reasons, I've said let's assume in both cases these are the numbers. Now looking at the likelihood. So it's a little bit of venture capital's dirty secret that everybody manages to find a way of cutting the data to show how attractive their returns are. But if you look at we've got some competition noise from over there. If you look at the overall venture capital market in the US and all the data from that over a number of different periods, the overall returns have been no higher than the NASDAQ. And if you think about that from an entrepreneur's point of view, these are the returns from the successful businesses that managed to get some VC funding at all. And there are a whole bunch more that burned up their friends and family's cash before they ever got to that stage gate. So that's the US numbers. In the UK, it's even more depressing. And if we look at that from the individual entrepreneur's company perspective, on this chart, you look across all that data, it means that of all of the venture funded, i.e. the positively selected businesses in the US, about a quarter of them returned the venture funders' money, and less than 10%, so between 1 in 10 and 1 in 20, returned a meaningful return of 3x over the period of history that we looked at. Now let's look at the venture builder route. Now, unfortunately, there aren't large aggregate data sets like there are for venture capital that we can use, but there are a couple of examples. The most prominent one is Rocket Internet, because they're a public company and they've shared stuff. And their data shows that about 80% of their companies are still successfully trading or have exited at a positive outcome. It's not quite like for like. We're not looking at 3x, and Rocket is one of the more successful ones. So I've been conservative and said, let's take that down to 60% in terms of our analysis of the two routes. And if you look at Blenheim Chalcot, the business that I know, and although I've joined it fairly recently, I've been on the board of companies in Blenheim Chalcot for the last 5 years and have been an investor, so I know that model pretty well. They've seen about 90% of their businesses either still trading or exiting with a positive return. So if you put those different factors together, for the traditional venture-funded route, you can say that on average, if you're doing okay, you might end up with an exit worth 25 million, of which you have a 20% share, but you've only got an 8% chance of that happening. So probability weighted, that's a £400,000 return over, let's say, a 5-year period. Now, for most entrepreneurs who could otherwise work at PwC or McKinsey, that's not a very good way to spend your money, spend your time to earn a financial return. If we look at the venture builder route, and again, these numbers are directional, but let's say you've got a 10% share of a 25 billion exit, but there's a 60% chance that will happen, and the whole process has been accelerated so it comes through quicker, then you're getting a decent return on the hours that you're spending. So right back to the beginning, the objection to the venture builder route is often that, well, I don't want to give up the vast majority of my company's ownership to somebody else because I want to get rich. Now, if you're wildly optimistic and you think that you can buck the odds and you are the best entrepreneur in the world and you will go against all of history of all the other entrepreneurs, then go the solo route. But if you want to play the odds game and improve your chances of success, then you can go this route. And if you put those two side by side, it means that you've typically got a 3 to 4 times weighted average chance of making money through this route. Now, there are lots of different flavors of venture builders. There are names of some of the companies along the bottom, and some of them are very much copycat factories. They look at successful tech businesses in the US, and they take those models to less developed internet markets and roll them out for future sale. Others are much more ideas factories, where they come up with fresh ideas. Some just work in markets, some work globally. Some, crucially, are just purely funded by the family money of the founders. Often it's a founder who's had a very successful exit, feels like they know how to launch companies, and they put their exit money into helping build out others to scale their impact. Whereas others will bring in external money. And when I talk about the venture builder providing all the money, as I said, often they will actually provide that money by bringing it in from other sources, but they take that money-raising headache away from the entrepreneurs. And then some will take you through to a minimal viable product that's ready for launch, and some will take you all the way through to exit. And you see some of the names there, Hitfox, Rocket Internet, you'll know well. Rocket Internet, Global Food Network, or Global Food Group, Zalando, I think a 7 billion euro now public company came through this model. In fact, IAC is another venture builder which spawned Tinder, which is now a very well-known and valuable business. So there are quite a few examples out there. But wherever they are on the spectrum, pretty much all the venture builders will provide the majority of the stuff in this chart. And while there's a lot of information here, you can see the kind of things that you as an entrepreneur need to be successful listed along the left-hand side. And in some cases, angels, accelerators, venture capitalists will provide a chunk of that stuff for you. But in every case, a good venture builder will provide the majority of it. The one place you might say it's weaker is in the brand recognition. So if you're lucky enough to be accepted by Y Combinator, or if you're funded by Sequoia Capital or Andreessen Horowitz, then that brand halo can help you succeed, help you attract the right talent, help you get a positive exit. But for the majority of the people playing in this space, those aren't so strong. And actually some of the venture builders, like Rocket, are also starting to accrue that kind of brand value as well. So let's talk a little bit about the business that I'm in and our learnings along the way. So as I said, Blenheim Chalcot's been running for about 15 years, building a whole bunch of different companies, largely based on technology, in different sectors, and exiting a bunch of them. They've built 27 companies, they've had about 11 exits, they've been very successful. There were a couple in the fintech space, and what I've done is come in, taken over that fintech area, and I'm now running that as Brightbridge and expanding that business into new and different areas. And what we tend to do is to commit investment of £1 to £10 million into these companies alongside the CEOs, that we focus on consumer and SME facing propositions in the fintech space, so areas that we know well from our experience. So I'm from Capital One and Google, as I said. I've done a lot of that stuff, whereas I wouldn't be so comfortable doing Bitcoin stuff or back office risk management for an insurance company. Although it's still fintech, it's very different to my skill set that I can help with. UK based. I mean, the whole point of being a venture builder is that you are hands-on and helpful. And if your management team is in a different time zone and country for you, it's very hard to make that real. So focusing on UK-based businesses, although they may have global markets, and looking to seed and grow 1 to 3 companies a year. This chart you're not supposed to read, but this is the Blenheim Chalcot timeline showing the companies that they have launched. The diamonds are the exits. The ones on the right-hand side are still live. And you can see the financial services chunk getting bigger there as Brightbridge has accelerated its progress. And in terms of returns, over that 15-year or so period, there have been a large number of companies that have been invested in that have reached some kind of conclusion. Either they've been closed down because they failed, in a couple of them, or they have been successfully exited. And if you put all the money invested, all the money returned to investors divided by the money invested, that's at a 10.8x return. The return is even higher if you look at the partial exits, where there are some existing companies still going, where we've taken outside investment and capitalized some of the value that's been created. So I think that shows, another data point alongside the public data that Rocket has shared that shows how the venture builder model can be successful. And a few examples there. ClearStart, 8x return with a 12 million exit. Avivo, 30 million on a 7x. Corporate Pay again. And then TDX Group. TDX Group, perhaps our most successful exit, 200 million sold last year. And it also illustrates another powerful data point for the success of this model, in that we often see venture leaders in these companies will leave through an exit because they go to the acquiring company through some kind of earnout, but then they come back and they do other business launches through the Blenheim Chalcot system. And so there was a guy called Mike who started with Net Decisions, which was our software and tech building platform. Then he went to ClearStart, which is on this. And then when that sold, he went to Florian, one of our existing companies, which is doing education work. There's a guy called Louis, who was at Net Decisions again. He went to Envio, a management team there, and is now part of another business that we're running in the digital media space. And then there's a guy called Ollie Betts, who was with TDX as part of the management team that helped build that company to the £200 million exit. And then after leaving for a while post that exit, he's now come back, and he's back with Blenheim Chalcot, and he's running another of our businesses. And that business is called Business Finance Compared. And so, Ollie, if you would come up and join us, you can tell us a little bit about our business.
Thanks, Dan. So hopefully my mic's on now. Thanks, Dan. Thanks for the introduction. As Dan said, I'm co-founder and CEO of Business Finance Compared. We're an online marketplace that connects small businesses with the finance that they need to grow. Dan gave me about 5 minutes, which is very kind, so I'm going to spend that time telling you a little bit about my business and also giving you some insights into what it's like to be backed by a venture builder from one of those people that's doing that right now. So to give you some background on Business Finance Compared, I've been an entrepreneur for quite some time now and a small business owner on and off. And so I've been through the process of applying for finance at various stages and in various different businesses. And I describe that experience as a combination of confusing, frustrating, and certainly very painful. And that's really where Business Finance Compared comes from, to make that process a lot easier. Now, if you take a look at consumer finance, that market's transformed entirely over the last 5 years. Everyone knows, I'm sure in this room, if you want to get a good deal on a credit card, you go to Money Supermarket and they'll get you the best deal available. We now see that 50% of consumer loans in the UK are originated through an aggregator. And those aggregators are now becoming more powerful brands than the direct financial service providers. Now, those consumers who are using those types of aggregators are the same people that are running small businesses. And as we know, those small businesses are the lifeblood of the UK economy. They actually account for well over half of the UK economy. And so we were really puzzled that there wasn't really an option out there for those small businesses to help them find the best deal. And so that's where Business Finance Compared comes from. So I'll give you a bit of an insight into, this is a video capture of how the site works. Now, the majority of small businesses, the first challenge they have with finance is they don't necessarily know what they want. What they start with is they know how much they want, and so that's where our journey starts. We then use a series of what I call hard-cut qualification questions to build a profile of that small business. What we're then doing in the background to the platform is we have a decision engine that's got configured profiles for all of the lenders that we work with. Now, our research shows us that small businesses really rely on certainty as the most important factor to choosing finance. They want to know what they're going to be approved for. That's because they're very time poor. So the majority of businesses spend less than an hour searching for the finance that they need. And they actually leave it till about a week before they need the finance, before they start a search. As you can see, once we've processed the customer data, we're then instantly matching that small business to the finance products that they qualify for. And then that business can compare the options they've got available to them and select which lender they're interested in applying with. What we then do is hand off the small business into the application process of the lender directly so that you've got a frictionless online journey. So that was just a quick demo of how the platform works today. Within about 4 months of actually founding the business, we've already got thousands of small businesses coming to the site every week. And that rate of growth really has only been possible because I have an unfair advantage with the fact that I'm backed by a venture builder. So I'll give you a couple of examples of how that's really helped me accelerate the growth of the business. So the first thing to mention is when I came up with the idea of Business Finance Compared, I was still with another company. And I had a 6-month non-compete that I needed to serve out before I could start the business. But as I'd started to talk to people in the industry about the opportunity, I quickly identified that this market really is a land grab. It's about moving fast and gaining that first mover advantage. So I started to talk to Brightbridge and to Dan and some of the other guys at Blenheim Chalcot. to see how I could get this business started faster. And so the thing they were able to do, because of the network of companies they've got, is actually get me a tech build underway with me overseeing that tech build from a distance. And so when I landed in the business on day one, I already had a minimum viable product, and I could focus on scaling up that business and driving volume to the platform. And that, I think, I would estimate saved me at least the whole 6 months that I had originally had the idea before I could actually start and found the business. Another critical success measure for my platform is the credibility of the platform. And how we achieve that is by having an association with what I'd call hero brands, our partners and the lenders we work with. And so Brightbridge has helped me, because of the network that the guys have got, to connect me with all of the senior business leaders within the retail banks in the UK and the alternative finance providers. And those are the guys that are my clients. So, for example, last week, I did the keynote at a breakfast that Brightbridge hosted. We had attendance from the British Business Bank, from Lloyds, and from Funding Circle. And so that's enabled me to leverage the existing partnerships and trusted relationships that are in place. What that means, within just 3 months of launching the platform, I've got 30 lending partners that I'm working with, and I've got all of the retail banks and other leading financial services brands coming on board in the next couple of months. I guess lastly, the other thing that a venture builder teaches you, although this might be just something that Dan teaches you, is that every platform is an opportunity to pitch your product. So I make no apologies for doing that today. In fact, if there's people in the room who are small businesses looking for finance, or if there's people who can provide businesses with finance, then come and have a chat with me, because we're able to connect you guys together. So that was it from me. That was very quick. I'm going to hand over to Justin, who's another guy who's backed by Brightbridge.
Thanks, Ollie. So just before Justin comes up, there's another business in our portfolio called ClearScore, and Justin joined that business having worked with me in a previous company. So again, using the venture builder network to bring the right kind of entrepreneurs into the right kind of roles.
Great. So I'm here to tell you a little bit about ClearScore, and I'd like to share my experience of doing it yourself versus venture building. So I'm a third-time entrepreneur. So I set up my first company when I was 27, and for those of you that have been entrepreneurs, that one was a massive failure. Lost a huge amount of money, burnt out within about 2.5 years. When the market crashed in 2000, we crashed with it. And it was a very, very difficult experience. Then in 2009, I set up another business that was called Allow, that was a privacy product. And I took that through 2 rounds of capital raising. And eventually I sold that in Q1 2013 to an American technology company. It was a decent return, decent exit, but it wasn't a hit the ball out of the park. And in my latest one, ClearScore, which I'll tell you about in a sec, I've chosen to go the venture building route for many of the reasons that Dan talked to you about. So what I'm going to do now is I'm going to give you about 5 minutes just comparing and contrasting the experience that I had at Allow, which was a classic venture capital, me with my sharp suit on, going around desperately trying to raise money from loads of VCs, and frankly, having my time wasted by most of them, versus what I've achieved in the last 6-7 months with ClearScore and the team at Brightbridge and Blenheim Chalcot. So let me tell you firstly about ClearScore. So this is the pitch. So very simple business. About 5 million people a year want to see their credit report and credit score. Currently, they have to go and take a £2 statutory report from one of the big credit reference agencies, or they can pay for a service like Credit Expert from Experian, which costs them about £15 a month. And if any of you are customers of that, you'll know that you get access to your credit report and your credit score for £180 a year. As of next month, when we launch, you'll be able to get a better service for free. Okay? So you'll be able to get your credit score and your report updated monthly with alerts for free. And the way that we monetize the platform is it's paid for by advertising. And because we can see your credit profile, we can match you to offers for credit and about 1 in 10 people who hit the site we think will be in the market for a new credit card or a new loan. And because we can match you to the right offers in the market, we can take some of the guesswork out of applying for credit cards or for new financial products. We're following an established model, so if you want to see what business we could become, check out creditkarma.com in the US. They have been going for about 5 years. They've just acquired their 45th millionth customer, and they are now about 20% of credit card sales in the US. So if ClearScore is successful, what Ollie said, which was most people go to Money Supermarket, if ClearScore is successful, hopefully what will happen is you'll check out your credit report and credit score when you're next in the market for a credit card or a loan, and you'll choose one of my products rather than going to Money Supermarket. So that's what we're trying to do. So let's have a look at what we've achieved in the last few months. So in my experience, and for those of you that are entrepreneurs, you have to be an optimist in order to be an entrepreneur, because all the odds, as Dan has said, are stacked against you. And what there is there's a fight going on between your optimism and your increasing level of experience and battle scars that you have. And so the reason that I've chosen to exploit ClearScore and to do that within the venture building model is threefold. The first one is that speed is really important. The thing that I've learned is it's not really the idea. Yes, you can be Facebook, yes, you can be Google, but most startups, most successful new businesses, it's all about execution. And to be able to execute, you need services, you need speed, you need support around you so that you can move really, really quickly. So if I look at Allow, my second startup, we raised £400,000 of seed capital from angels, and it took us about 6-7 months to get our first platform out. And then it took us another year to get our second platform out whilst we were raising our Series A. In the venture building model, I've had access to much more capital, and we started this business in October last year. My CTO joined on the 5th of January. We've recruited a whole team, and we will be launching a fully compliant FCA authorized platform in 2 or 3 weeks' time. And so in 6 months, it's allowed me to go from a cold standing start through to a platform which I'm really proud of, that is a really, really robust platform that will allow consumers to see and interact with their data in a much shorter amount of time. And what's enabled that is I haven't had to think about office space, I haven't had to think about payroll, I haven't had to think about changing the bins or what tea bags we put into the kitchen. I can just focus on recruiting a really amazing team, getting them into a space and getting them really focused on delivering the business. The second piece of the puzzle is as the business scales, as we get into market, having been through the fundraising process, it is extremely painful. So when I was raising my Series A for Allow, I saw 40 VCs, 2 of which ended up investing, 1 of which told me to go away because they thought the idea was crap, 37 of which wasted my time. And I went to meeting after meeting after meeting, PowerPoint, recut the data, because you're so desperate to get the money in. And so a big learning for me was I wanted access to capital that was much more easy to access, and I could pull that services around me so that I could scale the business really quickly. And then the third piece of the puzzle is support. And again, for those of you that are entrepreneurs, it can be a very lonely road. So when I was setting up Allow, I spent the first 6 months with my CTO on Skype. He was in Chester, I was in London, Skyping all the time, sitting in my home, doing product stuff, analysis, doing some commercial things, and it was pretty lonely. And what I think the venture building model allows you to do is it allows you to get an infrastructure around you pretty quickly, which allows you to access people, access insight, access people in a way that cuts down that loneliness. And it's those 3 reasons that I'm really, really proud to be working with Brightbridge, Blenheim Chalcot, QED, my other investor, to really take this new model into the market. That's it.
Okay, so a quick summary, and then we'll take some questions. So if you have any questions, please have a think about what they are, and we'll try and address them in a moment. So just to sum up what we've talked about here, if you go the venture builder model, you're making a trade, let's be clear. But you're trading ownership for speed, for pain-free funding, for more time to build your business. You're trading early control for the experience and support that those investors can bring to help you have a successful outcome. And you're trading the size of the jackpot for a lower risk and a higher overall risk-weighted return. And that can really open up the startup world for people who can't take that bet the bank, bet the house risk at the time of the career that they're in. And so we're actually seeing great success in bringing in much more experience, much more mature, much more able to stretch themselves entrepreneurs into this model than you typically get going through the VC route, which I'm really proud of. So with that, I will stop talking and see if anybody has any questions. Please, you have to shout them out because there's a bit of a zoo in here. Hang on. Oh, no, there's a roving mic, even better.
So this is a question to you, Dan.
Hold
at the moment,
I've
received a offer. So it looks like I'm going to go down the VC route. So I'm quite glad I came to this meeting because I didn't really know about venture builders. So I'm just wondering in terms of time frame, let's say I present to you a good idea. How long would it take? Because it seems like there's several layers of management potentially, I don't know.
Yeah.
That's, you know, so I'm just wondering.
So the first thing is that not all good ideas will get funded by a venture builder because one of the key constraints is capacity. Because it's not like writing a check, and as long as there's money in the bank, I can take it in. So you will have to take your idea to a venture builder at a point where the partners there have got the bandwidth to take something on. If you are lucky with that, and if they love your idea, certainly in our case, we could have an agreement to fund you and bring you in within 4 weeks.
Okay,
so it doesn't need to take a long time.
Okay, so would it be possible to speak to you later on? Is that...
It would be possible to speak to me, absolutely.
Excellent. All right, thank you very much.
Oh, sorry, there's one here as well, just close by.
Just a quick question. Is it fintech only or other technology as well?
So for Brightbridge, it's fintech only. The Blenheim Chalcot group does look at other things. And if you look at other venture builders like Rocket Internet and the other ones I showed you, they tend to operate across a broad spectrum. But we decided to focus Brightbridge on fintech just so that we could to fine-tune our expertise and our network to be the most helpful to the businesses we're working with.
And you always say I'm taking in the CEO, basically.
Sorry, can you hold it a bit closer?
Is it CEO or the whole team that you're taking on? If you have a venture team?
So it varies. Typically, the CEO is the anchor. In Justin's case, he very quickly found a CTO that he was really happy with, and he's been fantastic. And Ollie, you've brought some folks across from your previous role as well. But we like to anchor it in the CEO, and then they can bring others with them. And I should also say that sometimes the venture builder model starts with an idea that the venture builders like the sound of, and then they go and find a management team to take it. And sometimes an excited management team, perhaps in your case, sir, would come and say, this is what I want to do, will you help us? So in your case, it's more likely that you may have one or two people around you that you say, you know, we're a package, you take us all or none.
Do you invest in health tech space, health tech startups?
Can you say?
Health tech.
Health tech, not for us,
No.
not in our area, no.
Okay.
I'm sure there are others out there, but not for us. Yeah. Yeah, one here and then one over there. Yeah.
I was just wondering when, for example, the two boys here that have actually set up a new business with you guys, you've actually got a good business model, you've got, you know, all your finance, all your risk management sorted out, but there's big risks and so forth associated with the tech component of it. And I understand you've both selected CTOs, but, you know, the tech delivery part of this, there's an overseeing of that, I suppose, to manage that risk. I'm just wondering how that fits in.
Do you want to talk to that, one of you guys?
So we've benefited a lot. So we have our own technology team, we're building our own platform. But the fact that there's so many technologists within the groups has really supported my team in making some of the decisions that we've made and giving us access to suppliers at much better rates than we ever would have got otherwise. and we can leverage some of the infrastructure that's there. So I don't have to go and buy my own data center or go find that. I can piggyback for an MVP, for a minimum viable product, off the existing infrastructure, and then as we scale, we'll move on. So I think from a technology point of view, it's been really efficient.
Yeah, and I'd echo that and talk a little bit about recruitment. So that's probably another key part in the tech, is how do you get good talent? So my business is actually based in Nottingham, so we've got the disadvantage already that we're not in London. But what we've been able to do is there's 3 different businesses in the Blenheim Chalcot group in Nottingham. So we actually use an umbrella brand for our tech recruitment and hiring. And so then we're able to get a greater scale. And now we've actually got a really well-established brand. We sponsor hackathons on a monthly basis. And we're actually building a bit of a tech hub around Nottingham. So I think that network effect as well of being part of a venture builder is massive for talent recruitment.
And thank you very much for describing me as a boy. I haven't been described as a boy for a long time.
I have, all the time. So, yeah.
And I dream of it. Yeah.
Hi, to Ollie and Justin. Why did you go the venture builder route? It sounds like you both had experience. You could have done it yourself. Why venture builder? Why given so much of your ownership, I guess?
Ollie, you go.
Yeah, I'll go first. So I guess for me personally, I've worked with quite a few businesses and startups and helped them try and raise finance. And I guess that's partly where my experience comes from with the new business. I guess the other thing is I've been part of the venture builder kind of environment before. Dan mentioned a company that I was on the management team of at TDX. And actually, everything Justin and I have talked about, the speed with which you can grow, the network effect of the talent you have around you, it was just not only a successful experience, it was an enjoyable one. So for me, it made sense to build on that, take more of a leadership role and be the anchor of that, but in the same environment to get the same benefits.
Yeah, for me, it's just all about speed. So I'm in a hurry. I want to get this business out there. I want to get it out to consumers. I think the time is now for it. And so anything that I can do to tip the odds in my favor and give me faster route to market is very, very high in my agenda. And my determination was that the venture building route would allow me to be faster, and it certainly proved that way.
Okay, I think we've got time for one last question. I've just been given the time cop.
What say do the management team have in the final exit? You only own 10%.
So I will answer that. So in any case where you've got a lot of significant investors and the management team is diluted down to a minority, then it is the majority owners that have the casting vote in that exit discussion. So there's no different here. But the difference here, I guess, is that we are partnership investors rather than financial investors. So, and we recognize that our strength is about having an ecosystem of founders who will come back in and reinvest their time in the next startup. So while the financial owners, the venture builders, Brightbridge in this case, will have the ultimate say in how and when we exit, I think we've got stronger incentives to do that in a founder-friendly way than if you're a majority owner from a typical VC or PE type organization.
And just to build on that, I mean, so the absolute level of equity is obviously lower, and you fast track to that by going this route. But the way that Brightbridge do it and Blenheim Chalcot do it is it's a very fair structure. So when I raised Series A, there were multiple preferences, there were different classes of shares, et cetera, because obviously the VCs always generally try and protect their position first. And what I like about the venture model route is that it's true shared equity. So we're all on the same platform. Yeah, I might have less of it, but I know that I'm not going to get stiffed if something happens, and so it's a much fairer. It's a much
so
fairer system.
everybody has ordinary shares, and there are no different classes for different investors. I think with that, I think our time is up. I want to thank you all for your attention. I know it's a bit difficult in this noisy environment. Thanks for your great questions, and good luck with your entrepreneurial careers. Thank you.